I think it's at 5 instead of 4. 5 is start the chapter 11 handout. A lot of stuff here. This might be a little ambitious, but we'll see what happens. Okay, so first up, let's do the fast and fun footwear. This is kind of stuff coming from the CFE exam, Certified Fraud Examiner exam. And it's sort of like, how do you identify likely suspects? One of the things about auditing is that a lot of times when there is a problem, you get called in. So whenever they find a problem with, something being stolen, something, whatever, a lot of times they'll call in the auditors and say, here, see what you can find about this. So this is actually kind of can be somewhat of a common occurrence that you would be called in if there was a problem. Anyway, so go ahead and read through here. It's not very long, but give you a minute or two to read through the at the bottom, and there's no definitive who took them, but which the following would most likely be the most likely suspect. So go ahead and just put it in chat. We're not gonna. You can even private message it in chat if you want. But if you think it's salesperson A, salesperson B, or the customers, just go ahead and put that in chat. Anyone else? Want to weigh in? This is just like a real election. Let the people vote. Okay, well, we'll stop it here then. You're right, Courtney. Most likely suspect is probably going to be salesperson B. Now, we don't know that for certain. We don't know any of the facts, but the question is, what do you, which one is more likely? Okay, anger. Anger is the normal emotion when people are accused of something they didn't do. So anger is sort of what you would expect if someone didn't do it. Now, it doesn't mean that salesperson A didn't do it, but that is the normal response is with someone is accused of something. And you'll notice something else about A's answer. There's no alibi. Now, a lot of times they just get mad. That's kind of the normal thing. So salesperson B replied, I couldn't have taken the shoes. I was in front of the store all day with customers. Well, you remember that they didn't know whether they put them on the floor or not. So the fact that the salesperson B was in front of the store does not necessarily mean anything. Although it's kind of thrown out there as a anyway, all my shoes are from the front of the store. Okay, here's another thing that happens a lot of times when somebody is deceptive. They offer alternatives. A customer probably took it. Now, it could be that the customers took the shoes, but it sounds like it's a whole box of them. I guess it could have happened, but most likely. But they use vague terms often. They'll probably this, maybe this happened. They offer alternatives to what the actual is. And the reason they use vague terms is because they don't want to get cornered. So vague terms are very common in that, so someone says, well, that's going to happen. They say, well, I didn't say it did happen. I said it probably, or maybe it happened. They have that out of by using vague terms. Salesperson B says, besides, they already have a pair of those shoes, which means they like them. But second of all, why would I take them? This is another kind of a red flag, and that is sometimes, a lot of times theft and things like it are irrational acts. You'll get people that'll lose $100,000 jobs for cheating for $500 on their expense report or whatever. But one of the things that is very common is they try to get whoever's talking to them to explain their irrational behavior. Why would I do that? Why would I do this? Why would I steal $5 million? Whatever it is. Whenever they say that, why would I? That's one of those things. It's a key, and that's one of those things that, again, they're trying to put it on whoever is, I'll say the accuser, or whoever's investigating, to explain their actions, which a lot of times are not rational. A lot of times stuff isn't rational. Okay, so this is one of those things that kind of you would it would raise suspicion. And two, the fact that salesperson B has an alibi, that's very strange also. And it's strange because if I asked you, what did you do last Thursday? I don't know, I went to work. What did you do at noon? I don't know. Went to get lunch. Where? I don't know. I ate it, I think. Most people, they can't remember what exactly they were doing when something like this happens. So oftentimes, that if someone were to ask them about it, they would have to sit and think. Because most time, we don't really, you go from day to day, you don't really think too much about what you're doing all the time. Okay. And these are some of the, what's the following is a characteristic of a fraudster. Fraudster being the coolest word ever. Thing up here. Okay. Let's go through these. Highly respected.
They can be.
Yep, a lot of times they are. Committed a violent crime in the past.
No.
Nope, generally not. Committed fraud in the past.
Possibly.
Yeah, it's one of those. Fraud has a very high level of repeat offenders. As far as for instance, in the prison population, they go to jail for 3 years, they come out and they go back to jail, a year later or whatever. Highly religious.
Probably not.
You'd think so. Actually, it is.
Hmm.
Now, don't go crazy with this. Don't go accusing people who are highly religious of being fraud. But one of the characteristics of some people are fraud is a lot of times there are people that will, go to their synagogue or church or mosque or whatever, 3 times a week. This is one of those strange things. Young.
No.
No. Yep. Middle-aged.
Yes.
Yes. New employee.
No.
Old employee.
Yeah.
Yep. Friendly.
Yes.
Yep. Extroverts.
Yes.
Punctual.
Yep.
And college educated.
Yes.
They usually are. If you want to know what you want to fraud, the characters of a fraudster, they look like me. And that's why one of the reasons why fraud is hard to identify, because a lot of times they'll look like a normal or even one of your better employees. They're punctual on time, they're friendly, they go to church or mosque or wherever, regularly, and you think, oh hey, these people are on the up, but this is the kind of the characteristics you're gonna be looking at. And this is one of the reasons why it's hard to tell. It's hard to find someone. And again, a lot of times that they will repeat. It's one of those weird things about it that, different than the normal, say, prison population, is that I think only people like sex offenders or something like that have a higher recidivism than people commit fraud, but it's very common to have them get out of jail and then commit fraud again. So anyway, these are just kind of some of the things if you take the CFE, the Certified Fraud Examiner exam, these are some of the things that they'll kind of go into. And they go into a bunch of other stuff too, but this is one of them. Any questions on that?
Mm-mm.
All right. Let's pull up the kiting one. Okay, and this one is just kind of what we're looking for is kiting, and kiting by definition is when you're trying to make it look like you have more cash than you really have. However, it is also possible that you can use the same mechanism to make it look like you have less cash than you have, and as we'll talk about at the bottom here, technically that's not kiting. It's still fraudulently listing your cash or whatever, but kiting is made to make it look like you have more money than you really have in your account. Okay. And so you can see this in different formats, and this is one of the formats that I think was on the CPA exam before. And that is, the disbursement and the deposit, and they have the book and the bank together for each one of them. Okay, so this first one. Is there any, is this kiting? Yes or no? Remember the criteria? It has to be made, it has to be recorded on the books generally before, I don't say generally, it has to be recorded on the books before or at the same time as the deposit. And the journal entries must be made at the same time or in the same period. So.
What was it? One more time? You put it on the same, one more time?
Yeah, that the book before so the book journal entries and the second criteria is that the entry, sometimes it'll be entries. To be at the same time, the same period is what we're really talking about here. Oops. So the same year, basically. So the journal entry should be made at the same time. So the book entries, journal entry should be made before or at the same time as the bank deposit, and the journal entry should be made in the same time, at the same time period, for example. Okay, so for instance, this first one, they made a journal entry, the book entries are made on 12/28. And it was deposited into the bank on 12/28. So it looks like they're made in the same period at the same time. They're made at
Yes.
the same time. So is this kiting? I should say.
No, it's not kiting.
Yeah. I should make this more clear. This is a new handout, so it's won't help you guys, but it'll be improved for the next group. Okay, so no, this is not kiting. It looks like it's okay. Okay, how about the second one?
Same thing. Yeah, no, it's not kiting.
Good. Okay, the made at the same time, and it was made before. All right, how about, I should put in numbers on these. How about the third one?
The third one, yes.
Yep. They don't disperse it until after it's recorded on the books. So it's recorded, deposited on 12/31. You have to wonder what the other side of the book, the journal entry was. And it wasn't dispersed until 1/3. So this would be, oh, I didn't put no here for this one. So this would be yes. So this is kiting. It'll show up, whatever you receive will show up on the books on 12/31. And then what the disbursement won't show up until the following period. So it'll look like there's magically more money in the bank, or whatever the transaction they recorded here was. Okay, how about Portland, the 3580? Kiting?
Yes.
Yep. You'll notice that these are not made in the same period or at the same time. Oops. So that is kiting out. And two, on both of these, you also see that the disbursement is not made before the deposit is too. So actually this would fail. Okay, Citibank.
No.
Nope. This is not kiting. It says everything's fine. It just didn't hit the bank. It was made on or before, in this case before. And they're both made in the same period. No. Some wacky ones down here.
No, for the first one.
The first one is actually, they're made on in two different periods and two different dates. So this is going to be a problem anyways. However, this is not kiting. This is trying to make yourself look worse than you really are. Notice that they booked a disbursement before the receipt. So this is to make it look like you have less cash than you really have. Kind of an odd one. And this one down here is kind of odd too. And this one is one of the ones that, this is one kind of breaks the rules a little bit. You'll notice that they're made in the same period. However, they're made after the bank deposit, right? But here's the odd thing. It was also picked up on the same day in the other bank. So this is, the last one's kind of a weird one in that it is, the individual bank accounts will be off, but if you net them, the cash account, one cash account will be too high, one cash account will be too low. But actually, if you net those out, they'll be exactly the same. So this one actually, even though it violates the rules of journal entry before the deposit, because the deposit was in the same period and the journal entries were in the same period, it snakes through. It won't look like there's anything overstated or understated. The cash accounts will be off, but in total they'll be okay. Okay, any question on that? So yeah, so and by the way, this is called the transfer schedule. I should put that. So it's referred to as a transfer schedule. And it's usually not too difficult. Let me restate this. It's it's more difficult to do nowadays because a lot of times they're electronic transfers. Electronic transfers going at the same time. But one of the things you have to be careful of, especially if you're doing financial institutions, they have thousands of accounts going back and forth and all that kind of stuff. And if you're doing it, you know, for financial institutions, a lot of times you do have to be a little bit more careful because a lot of times you're dealing with thousands of accounts, and you have to go through and be a little more aware of transactions that might be occurring like that. Okay, let's do the multiple choice review. There's only 5 of them, so we should. And I will put the poll up. Now there's only 5 of them, so do 1 through 5, and then whatever you do for the 6 through whatever they don't matter. We're still working on it. Go ahead and finish up. I just want to mention that on the test, these are two things you're definitely going to have are the bank reconciliation And a kiting, kind of like the one that we just did. You're lining up the dates to see if they're in the correct period, all that kind of stuff. So those two will definitely be on there. There'll be a couple more essay questions on there. Is anyone still working on it? I don't want to close it if someone's still working. I think you can just private message me if you want. We'll see everybody. Okay, very good. Let's go through. Oh, I got to share the results. What am I doing? Okay. Which procedure would auditor most likely use to check outstanding at year end that was not recorded on the year end bank reconciliation? And yep, B is correct. Yeah, let me obtain information on the December 31st balance per bank, which the following, and A is correct because I don't know how to use a computer. No, the bank confirmation will have it on there, but also the cutoff bank statement will have it as the beginning balance. Now the tricky one. Which of the following transfers result in a misstatement of cash? Well, apparently it's not too tricky. You guys got that. Everyone got that one. Okay, good. Number 4 is correct. Understatement of outstanding checks. If you understate the outstanding checks, it makes your cash balance look higher. These are checks that you've written but have not recorded. And 5. Yep. Wait. Oh, 5. Yep. B. Very good. And the poll. It says stop sharing. I was like, yeah, stop sharing. I don't know how to share that. Chapter 10. Okay, so those will be added on there. Okay, exit the poll. Okay, let's go ahead and take a break, I guess. And we'll start in on the chapter. I think we'll start in on the sampling overview. What do I have here? Sampling overview. Okay, we'll start it on this one. So we'll say be back at 7:58. Oh, we'll just say 7. Okay. By the way, you guys, I sent out a second email about the job fair, and from what I understand, that there's gonna be quite a few of the accounting firms there. So it would be, I would strongly advise you to go check that out. And one thing I'll tell you about the accounting firms is a lot of times, if you say, well, I'm not going to graduate for another year or something like that, a lot of times they like to get you ahead of time. So I would encourage you to go ahead and at least sign up for it. And it's virtual, so it's in this next Monday. So anyway, it's a strong encouragement to go to attend it. Let's go ahead and get started on this. Some of the stuff I think we've already talked about a little bit, but we'll do it. Selecting a sample. I think we talked about this before. I can't remember. Random sample. This is the best sample. And why is it the best sample? Why do we want to have a random sample?
Are likely to represent the population.
Yep. Another way to is that it's unbiased. You'll hear that a lot too, that it doesn't show bias one way or the other. So random sample is the best, and that's the one that you know, if you can do it that way, do it that way. You can have a random number table. You could also have a computer generated. I'll tell you a funny one on that though. I worked at a place where this guy had his own computer generated random numbers. And back in the old days, when you first went into Excel, it would be a random number that would be generated, a random list of numbers, but they'd all be exactly the same on the first go around. And it wasn't until you recalculated that it would actually be a true random number. I should say that it would be a different random number than the ones that are automatically built into the system. So it was kind of funny that I remember pulling up the thing and running the statistics to pull a sample, and I realized it's exactly the same sample as they did 2 years ago. I didn't know why, and then finally we got it to bring up some different numbers, and it was only later that I found out that it's. I imagine they fixed it with later computers, but the first go around was, well, it was random. It was the same random numbers. First started up. Okay, systematic selection. This is, let's see an example. Example, pick every 10th item. So, and you may have a random start to it. Random start being 1 through 9. And then pick every 10th item. That's systematic. It's not as good as the random one because it's not, it's possible there's a bias built in. For instance, if something happened every 3rd item, you may not pick it up. But this is, I would say, would be the second best. This is the runner-up to the random sample. Haphazard selection. This is this one is samples picked by an individual. I don't want to say, I don't know if I use it randomly. It was befriended by an individual. I guess haphazardly is the best way to put it. and I'll tell you, that's like closing your eyes and reaching into the file and picking out a number, picking out what it is, whatever it is. So it's not necessarily random, but you closing your eyes. And another thing about it is it's not repeatable. So say close eyes. Oops. And it's generally not repeatable, because if I go up to the filing cabinet, close my eyes and pick out 5 items, and someone else comes in there and picks out 5 items, it'd be very unusual they'd be the same one. I did have to use this one time though. I'll tell you about that maybe, but let's go to block selection. Block selection is easily the worst. Spelling right today. Example. The entire month of October is the basis for a sample of so choose the entire month of October as a basis for the sample a sample of sales orders. So instead of picking them throughout the year, you just pick out a block of, say, October. There's an unfunny saying that if you block selection or block samplings for blockheads. Obvious the reason is the October may not and probably doesn't represent the population as a whole. You might choose that if there was a significant problem that happened in October you're trying to figure out, but generally speaking, block samples are not good for auditing of financial statements, because a lot of times they don't represent the population as a whole. Okay, haphazard selection. Kind of a strange one. I worked at US Steel, and we had they have tons of buildings at US Steel, because they used to have, before computers, they had thousands of people that would just do invoices and tracking and all that kind of stuff and pay vendors and blah blah blah. So they had these buildings that were just massive, and I mean they were like, in some of these places were almost the size of football fields or something in these rooms. So anyway, there's tons of these buildings available. If you want to get a working space in an office, you could have your pick of many of these places, because there's tons of them around. And so I was at this one where they did the billing, and everything is pretty much at this one big room at the end of the building, and pretty much everybody's in there. And nice group, but big area. They all spread out, nice working conditions, blah blah blah. And I had to do these special invoices that were made. It had to do with some special machining and stuff that was beyond the normal invoicing. But anyway, as I was talking to them, they said, "Oh, you got to go down to the end of the hall. That's done at the end of the other end of the building." Huge building. So I walk down this hall, and I can hear people talking. They come down the hall, and I come in the room, and it's just one woman, and she's just talking to herself. It was really weird. But it was she was a schizophrenic, and so I had my sample picked, I'd like to find these ones. And she kind of stared at me and said something. And I didn't, well, where would I find these? I kept, and nothing, just nothing, no response, or just a straight response. Most times she just stared at me. And then when I walked away a little bit, she started talking and talking and talking. So anyway, so I go back to the other end. I'm like, what's going on here? And they said, yeah, she's actually a schizophrenic, and she's completely normal when she takes her medicine, but she's not taking her medicine, and it's a union thing. They can't make her take her medicine. Okay, well, so I got the sample, so I called the supervisor, and I said, well, I don't know. I said, and I went back down there, and I couldn't make heads or tails out of how these were being filed. So I'm looking at these, and I'm, everything was there, it looked like, but all different, and so I'm trying to talk to her, and I can't talk to her. It's just nothing is coming back. So he said, well, how many items do you need to pick? I said, 40. He said, okay, well, go in there and haphazardly pick 40. He said, count however many boxes there are, and then, so if there's 20 boxes, take 2 out of each box, and we'll do it that way. So that's what I did, and it was haphazard again. No one else could have, if someone else would have picked a different, whatever, they come with different. But here's the kicker to the whole thing: they were all perfect. And just because someone's a schizophrenic doesn't mean that they're not. A lot of times they're very smart. So, these were like the most complex contracts and stuff that they were, the invoicing and all that, and they were absolutely perfect. So, but that's a weird one of the a haphazard selection. That, let's say I did not want to do it that way, and I remember thinking, well, there has to be some way, someone can pull this out, but there really wasn't. So, sometimes you just have to make do with it, and that's what we did. And again, we didn't find anything wrong with any of them. So, the ones that we did pick at least were fine. Okay. Stratification, I talked about this a little bit, I think, but it has to do with materiality, basically, for the most part. So we got a list of accounts here, accounts receivable. And of those first 10, which ones are probably the most interesting to you as an auditor?
Fifth one.
Yeah, this is the biggest one. So this would probably be, oops. This would probably be the most interesting one. It's the largest dollar amount one. And you'll notice that, compared to some of these other accounts, like compared to number 3, if number 3 was off completely, it probably wouldn't matter too much, right? I mean, if it was 0 or if it was twice as big, it really wouldn't matter. It's not going to be material. So you generally want to look at the larger dollar amount ones, ones that will be material to the total, certainly are ones you're looking for. Which one is most likely to be fraud?
Six.
Yep, good. One of the weird things about fraud is that a lot of times people who commit them do them in nice round numbers. It's very unusual to have a transaction that comes out to exactly 25,000. Maybe it can happen, but it's, usually it'll be $25,232 and 38 cents, something like that is usually what you're looking at. So when you see these nice round numbers, a lot of time, well, not a lot of times, but those are the most interesting ones because those are not usual business transactions. Again, could they happen? Of course it could happen, but it's fairly unusual. Okay, stratification of a sample. What you might do is stratify this sample, and you want to make sure that everything could be picked, but there are certain ones that are more important to you. For instance, 5 and 6, probably more important to you. Number 2 is, it's up there. So the question is, how do we do this? How do we make sure that we pick the ones that are most important? So you went out and doing a stratification of the sample. So anything that's over say 10,000. Maybe you take 100% of those. $1,000 to 10,000. You know, you're still interested in those, but not quite as much as the really big ones. So maybe you take, I don't know, let's pick this up, 40% of those, right? I mean, it may be less than that. Let's say 20, say 20% of those. And then those that are under 1,000, maybe you take 5% of those. So this is stratification of a sample. You'd really have it broken up into 3 samples, right? This first one really isn't a sample. This first one is just take everything and take a look at it. But these two down here, you'd have, you know, pick random samples for each of those and evaluate those ones. So this is one of the things that you'd try to do. Again, because the larger dollar amount ones just intuitively are the more interesting ones. They're the ones that could be material on their own even. So that's stratification of a sample. Attribute sampling. I can't remember if we talked about this or not. Yes, no test. I think we did. Attribute sampling is, well, let me give you an example. The purchase orders a purchase order signed by a manager. And again, these are what we term as yes, no tests. Oops. It either is or it isn't. Okay, so these are, they be called binomial sample. And these are generally used for used for testing controls. Not used for dollar amounts. So not used for dollar amounts. I'm going to put kind of the same thing in here. Not used to find material misstatements. For example, even if you find a purchase order that was not signed by a manager, it doesn't mean that that purchase order wasn't a valid purchase order, that it wasn't filled and all that kind of stuff. So even though the control might be bad, the dollar amounts might be fine. So attribute sampling, it's not used for dollar amounts. We cannot use it to find material misstatements. Yes or no does not tell us if there's a material misstatement in it. I think I already talked about this. Did I go through the thing about central limit theorem and all that? I thought I did. Maybe I didn't.
I don't think so.
No? Yeah, I'll go through it because it is kind of interesting, actually. Well, I don't know. I guess you guys would be the judge of that, whether it's very interesting or not. Sort of like this. Okay. So attribute sampling. These are yes/no tests, and they're a binomial. It's sort of like a 0 or 1. You know, that's a little blurry here. So it's sort of like flipping a coin. You know, you can go up with heads or tails. Oops. And if you actually do the math for this, it gets kind of tricky pretty quickly. If you do it kind of the way that they want you to. But we have something called the central limit theorem. And that is that all distributions will become the normal distribution when repeated. So if you do a binomial in your statistics class, you know, you'll see there's kind of a lot of mathy stuff involved in it. But the central limit theorem says that all distributions will become the normal distribution repeated. So no matter what the distribution is, it could look like this, it could look like this, it could look like you know, that. These will all become more like the normal distribution once they're repeated. And you'll see that when you flip a coin. So one flip could be heads, could be tails, and you have a 50% chance of it being either one. So it would look like this. Two flips. You could have 4 possibilities: head, 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 tails, tails, head, tails, tails. This is maybe a little, I didn't mean to put the edges on that. Now, if you don't care about the order, and we don't for what we're doing, it'll look like this. Heads are 0.25. Tails or heads or heads or tails, either one, it'd be the same. Oops. That would be these two together. You get one head and one tail, and then 2 tails. So, you know, if you were to graph this out, it would already start to look like a normal distribution. You know, to map this out, it would automatically look like a normal distribution. Started looking like a normal distribution after just, you know, 2 flips of the coin. So we use the normal distribution to look at attribute sampling because it's if things are repeated, it'll all come out looking like that. Ow. Just close the keyboard on my hand. Okay. Discovery sampling. I don't want to go too far much into this one. Discovery sampling is usually they'll take a I'll tell you how it's usually used. It's usually used to see if there's some, what the chances there is if there's a problem with you could be looking for fraud, or you could be looking for a quality control thing or something like that. And a lot of times these will be number of items picked. A number of items picked without an exception. So if you have they have tables for this. So if you pick 50 things and you don't find any exceptions, and the total population is, whatever, 1,000, it'll give you a percentage saying, okay, if 50 of them don't have that, then there's this much of a chance that there's no error in that sample. And then the more items you pick, the higher your confidence goes that you are on the right track, or that nothing bad will happen. That's the way it's used a lot of times, and it's used to try to discover something that's happened, fraud or whatever. Last two are things we've already done. Classical sampling. Per unit, ratio estimation. That's not right. Difference estimation. And these are substantive tests used for finding these are for dollar amounts. And you remember we did that, detected error and all, mistake and all that. And same thing down here for the monetary unit sampling, which we just completed, same thing. These are substantive tests, and they're to see if they are materially misstated. We're looking for dollar amounts. So substantive tests are what we use to look at for dollars. So substantive tests are used for dollars. Most of the time what we do is this: we do test of controls. If you don't have to do test of controls under the AICPA, but you can do it. And for some things we have to do it that way. But anyway, so test of controls, and the test of controls will let you know what problems to look for when you do the substantive testing. So the test of controls, these up here, these attribute sampling stuff up here, this won't tell you dollar amounts, it's off by, but if you find controls that are weak, it'll say, okay, when we do the testing, we got to test those, for those weak controls down here to find the dollar amounts, material mistake. Okay. Oh, one more dual purpose test. Dual purpose test is kind of a common sense one. And that is if you had so test controls, 100 items are needed, or substantive tests. Say you had 500 items needed. Well, 100 of these items can be used for both tests. So if you pick a random 100 items for test controls, then you only really need to pick 400 items, additional items. So these could be dual purpose. And then you'd have to pick another 400 items. Just say 400 additional items. So 100 items you use for both tested controls and substantive testing, and you really would only have to pick then 400 additional items because you're using 100 of them for both of these tests. It is one of those funny things that it's kind of common sense in that, but for some reason they tested a lot of them, or sometimes anyways, on the CPA exam. And the reason I say it's a little bit odd is that it really just goes down to the efficiency of the audit rather than the conclusions of it. Okay. You know what, I was gonna jump over to the other handout. I think I was gonna try pushing through this one. But I think we can finish this tonight. And then we'll be done with the sampling. Yay. Okay. And some of this we've already talked about. Allowance for sampling risk, precision. And this diagram would be for the classical sampling ones. You know, it could be overstated or understated. And you guys kind of know all this stuff. Okay, so this down here is kind of an important one to realize. For the same sample size, a lower sampling risk will have a higher allowance for sampling risk. Okay, so what that means is if you only want to be 68% sure, you know, it's going to be, say, 95 to 105. If you take this sample, it comes out to be, you know, you're projected to have $100,000. If you want to be more precise, you know, be 95% sure. Now you have to go down to 90,000 and up to 110,000. You know, plus or minus 10,000, so on and so forth. So for the same sample size, the more precise you want to be, the larger amount of this allowance you're going to have. A larger sample size can reduce the sampling risk. So that, you know, as you get a bigger sample, what am I doing here? So it's sort of like this. If you have a you know, if you pick, say, 100 items, it might look like this. You're gonna be more sure, and you pick, say, 200 items, you know, it would kind of look like this. It would be more, it would reduce. So this would be 100 items, and say this is 200 items. You know, it'll tighten in, get closer. So a larger sample size can reduce that, you know, that variation there. Okay, testing controls. Now, that's not me. You might think that, hey, you know, substantive tests tell us the material misstatement, so the AICPA is going to test mostly on substantive tests. classical sampling, mean per unit, ratio estimation, difference estimation, or monetary unit sampling. You know, what they'll look at those because those will tell us the material mistake. They actually test sampling for attributes more than they do the substantive testing, just in general. I can't promise on every test is like that, but in general, in the past, they've done it more of the test controls rather than the dollar amounts. Okay. And I think I've used this example before. For example, a client may have a control that requires 2 manager signatures on checks written for more than $5,000. The auditor, I don't know why I wrote it this way. The auditor would take a sample of checks written for more than 5,000 and determine whether they have 2 manager signatures. Okay, so they either have there's 2 signatures on the check for over 5,000, or there isn't. It's a yes or no. If there's 2 signatures, it's a yes. If there's 1 signature, it's a no. Okay, now the auditor says, okay, there could be an error rate of 7%. The allowance for sampling risk is 2%. And so what they mean by that is sort of like up here again. You know, the sampling risk, they say, okay, you know, you usually say this is 100% or is not a problem. But if you come up with some number, the allowance for sampling risk says, okay, it might be worse than what you came up with by a little bit or whatever it is. So back to here. So the results are following. They had a 200 checks, 194 of them had 2 signatures, 6 of them didn't. So what's the error rate?
3%.
So the error rate in this, you have 200 items, so 6 were. So this is our error rate, and this is the most, our best estimate as far as what the controls are telling us, you know, if we can use them or not, 0.03. But there's this allowance for sampling risk, that means it could be 2% more. So coming down here, the error rate was 3%, but we're saying it could be off by another 2%. So the error rate could be as much as 5% based on our sample and whatever the, you know, whatever level of confidence we have. So the error rate is 3. The allowance is 2. So 3 plus 2, it could be off as much as 5. Okay, so coming back to our problem though. From the results of the test, would the auditors rely on the assessed control risk for the client? They'll allow for up to 7% error rate. Are they going to rely on the assessed controls or not?
Yes.
Yes. They're at 5. 3 plus the sampling risk is 2. And so this would be less than the 7. Okay, that's not what I wanted. Okay. Yes, because 5 is less than 7. I'll put it up and down here. So we'll allow for up to 7. We're only at 5, so we'll say yes, we'll rely. Okay. The next thing we're going to go over is the idea that a couple things could go wrong when you're doing a sample. You could choose a sample that does not represent the population as a whole. Right? So it's possible you could reject a population that you should accept. Say, okay, we can't rely on these controls, where actually what you picked were an anomaly that, that you really can rely on the controls, but you just happen to pick a sample that, randomly pick a bad sample. It happens. If you're at the 95% level, 5% of the time you're going to be wrong. So you could pick they could have a good population, but you think it's bad, or the other way around. You could think the population is good. You pick your sample and it's below what you would deem as a problem, and so you say, oh, okay, everything's okay, when actually it's not. So the actual population versus the sample is when you can run into problems, and that's kind of what this table is looking at here. So here's the auditors. And here's the actual. Now, if the auditor tests and says that everything comes up adequate and the actual is adequate, then this is the correct answer. Same thing over here. Do something here. I thought these were all centered. If we say that they are inadequate, and they actually are inadequate, now these other two are going to be the problems. So these two are, hey, they match up with what the true amount is. The problem are these two. So you do testing and you come up with that it's inadequate when actually they are adequate. This is called an incorrect rejection. Now you could also come up with it that you think they're adequate when actually they're inadequate. This would be an incorrect acceptance. Okay, so these are the problems. These are when your sample does not match the population as a whole. You think it's adequate when it's not. You think it's inadequate when it is. Okay, so, again, if you're at the 95% level, 5% of the time, you're going to be sitting in one of those two spots. Which one of these is the most dangerous? The incorrect rejection or the incorrect acceptance?
Incorrect acceptance.
Yep. This is the one that's the problem. Ah. We got a new problem. So this is the problem. The incorrect rejection, this will lead to an inefficient audit. I gotta move my thing here. Incorrect acceptance will lead to an ineffective audit. I don't know. And we say inefficient audit down here because what will happen is you say, okay, I can't rely on the internal controls. So I got to really buckle down and do more substantive testing, right? I can't rely on these internal controls. And I was going to pick 500 items for substantive testing. Now I better pick more. Maybe I'll pick 1,000 or 1,200 items because I cannot rely on these internal controls. Now, had we got the correct answer that we could rely on them, we would have just taken the 500. So if you get an incorrect rejection, something's wrong, or you think something's wrong when it's not, you'll actually overcompensate for that by taking more substantive testing, and you should come up with the correct conclusion about material misstatements. And especially since you have a larger sample, you'd be more sure of it. The problem with the incorrect acceptance is you think everything's fine. Hey, these controls are working great. Okay, well, we can back off some of this testing. We don't have to do 500. Maybe we do, a lesser amount, or maybe we stick with 500 when we really should be doing more of them. So the problem with the incorrect acceptance is that the population is not represented in your sample. Any questions on that? And that is the most dangerous one. That's one they usually talk about as the one that they really want to try to eliminate if they can. Oops. So this is the real problem on here, and that it's an ineffective audit. The audit will not be up to standards. And again, this comes down to sampling error. And people say, what can you do to stop it? Well, nothing really. I mean, you can audit to say the 99% level. But even at 99% level, 1 in 100, you're going to get wrong. And you're going to take a whole bunch of items to do that. So, there is this kind of judgment thing. It isn't that sampling takes out that judgment. It just lets you quantify it. Okay, if we're at the 95% level, 5% of the time, 1 out of 20 is going to be wrong. We're going to be either ineffective or inefficient. Question on that? Hey, we might make it. Same thing holds true for, hey, we are going to make it. Yay! Same thing holds true for substantive tests, the dollar amounts. You classical, didn't underline very well here. So the classical sampling, monetary unit sampling, the ones we did the other week. Same thing down here. Not materially misstated, not materially misstated. Correct. Materially misstated, we catch it. They're actually materially misstated, we catch materially misstated, come up with the correct that. And again, we have incorrect acceptance of the amount. No. And again, the the problem is you think something is not materially misstated when it actually is. I'm sorry, I'm doing stupid stuff here. So the incorrect acceptance. You think they're not materially misstated when actually they are materially misstated. Okay. Now down here, this last little question is, suppose the initial test of the controls indicate that the controls cannot be relied upon. What should the auditor do? So you start doing the test of controls. You find out, let's say you get 20% into the test of controls, you cannot rely on these test of controls. Okay, so what's your next step? So you're doing what, go about 20% into the test of controls, and you find out you cannot rely on them. Are you gonna do A or B? Oh, make a guess. Do that coin flip thing we talked about earlier.
I'll go A, final answer.
It's actually B. If you can't rely on the controls, there's no reason to test them. Well, actually, I shouldn't say that. But generally, if the controls are, if you can't rely on the controls, you're just going to increase the substantive procedures. So if you can't rely on the controls, no reason to keep testing them. Jump right to the substantive procedures and increase those. Now, the exception to that is if it's a publicly traded company. First of all, publicly traded companies should have their controls under, they should have good controls. But if it is a publicly traded company, you're required to do the test of control. So you can't simply walk away from it and say, gee, these are really bad, I'm just going to do more substantive testing. So if it's a publicly traded company, you would finish we're doing the test of controls, even if you can't rely on them, and then to figure out what's wrong, and then but also increase the substantive testing. Another thing, I think I mentioned this about internal control, maybe I didn't, is even though there is a bad internal control, it does not necessarily mean that there's a misstatement. And remember, when we do the financial audit, at least according to the ACCT433, we are looking at the dollar amounts. Are they materially misstated or not? Can people rely on these financial statements? So even though there is a problem with internal control, the financial statements may be perfectly fine. So that also comes into it. The relationship between test of controls and substantive testing is inverse. It's inverse. And generally, the auditors don't determine that, at least not ahead of time. That's usually dictated by the controls themselves. So that if your testing controls are not going well, you say, okay, forget it, we can't rely on these. Then you go do the more substantive testing. If the controls are fine, then you keep your plan the way it was. So anyway, the test controls are inverse. If you do less of the test controls, and you can, for the ACCPA, you can even not test the controls if you want. I should probably put that in there too. For the ACCPA, it's possible not to test the controls. You just do more substantive testing. Test controls are optional, substantive tests are required. So AIC, I don't know why I got the bold and underlined. So test controls are optional. And substantive tests are required under the AICPA. It may sound kind of funny, but years ago, there were people that said, oh, you just have to test the controls. And if the controls are okay, then you know the financial statements are okay. And then we had Enron and WorldCom and all that. So now, you are required to do substantive testing, find the dollar amounts and see whether they materially misstated. The test of controls are optional. And you say, well, why do we even have those? Well, you might want to test the controls because it might reduce the cost of the audit and the time you're on the audit. If you can rely on the controls, you can say, okay, these controls are pretty good. I can rely on them. I can do less testing, substantive testing. So generally you do the test of controls from the AICPA's point of view if you are, if it will reduce the time and or cost of the audit. The PCAOB, if they're issuers, you must do test of controls because you also do an audit on internal controls that goes along. There's actually two opinions. There's one opinion on test of controls and one opinion on the financial statements for publicly traded companies. So publicly traded companies, you have to do test of controls. If they're not publicly traded, if they're non-issuers, then they're optional. Okay, is that enough fun for tonight? I think that's enough fun for tonight. So we'll have this one turned in and we'll start up with chapter 11 next week. And at some point here, we're going to have a review for just maybe a quick review for the sampling exam. The sampling exam is basically on, well, it's not sampling as you might imagine. So anyway, any questions? So I'll put a drop for this for the overview and the test controls. I'll put that in the in Blackboard, and that should be it for this week. Wait, I got to send out a test, don't I? I'll send out a test. Yeah, I should get it out tonight. If not, I'll definitely get it out by tomorrow. Probably tomorrow morning. But I should get it out tonight. And that will be a test on chapter 10. Any questions? Okay, have a good weekend.
Thank you. Sure.
Over. I'm sorry.
Thank you.